So here's the question for today. Is the markets just trying to be polite or just quietly plotting its next big jump scare? Between a pound hovering above $1.34, gold flirting with fresh records, and US equities tiptoeing on credit jitters, let's just say the popcorn isn't staying far away today. Before you place your next trade, watch this. Good morning, I'm Francois, your market analyst here at ATFX Africa, and welcome to your daily market brief. Each morning, I unpack the biggest movers across currencies, commodities, and indices, blending fundamentals, technicals, and well, just a little bit of common sense. Because let's face it, markets don't always make sense. Let's start in the UK, where the pound is showing a touch of quiet resilience. The British pound remains comfortably above $1.34 after GDP data came in exactly as expected, showing a 0.1% rise in August, followed by a 0.1% contraction in July. Manufacturing pulled its weight, but services were flat, and construction continued to lag. On an annual basis, growth of 1.3% isn't exactly setting the world on fire, but it's at least a step away from recessionary fears. For Finance Minister Rachel Reeves, this slight rebound offers a momentary sigh of relief ahead of November's 26 budget meeting. Still, she's got her work cut out for her. With roughly £30 billion to find through potential tax hikes and spending cuts, rising borrowing costs and softer growth forecast aren't helping either. Meanwhile, traders have started pricing in a Bank of England rate cut for next year, even though the IMF has warned that inflation will likely remain the highest in the G7 through 2026. That's like saying, sure, you can ease the policy, just don't enjoy it too much. Technically, the pound's edge is being helped by a slightly weaker dollar. As US rate cut expectations grow, the dollar index slipped again after the Fed beige book hinted at cooling activity, and Chair Powell noted further cracks in the labor market. With the dollar softening, cable has found room to breathe, hovering near 1.344 as of this morning. Over the past month, the pound is still down about 0.8%, but up just over 3% from this time last year. In short, not bad for a currency still juggling political uncertainty, sticky inflation, and, well, a pending budget showdown. Now onto something shinier, gold. If the pound is calm, gold is in full rockstar mode. The metal has climbed back towards $4,370 per ounce and is on track for its strongest week since March 2020. That's right. The last time gold ran this hard, the world was discovering the joy of sourdough bread and lockdown stockpiling. So, what's driving this rally? Well, pretty much everything that makes traders lose sleep. Renewed US trade tensions, an ongoing government shutdown, and expectations of multiple Fed cuts have fueled a rush towards safe havens. China accused Washington of, well, stirring panic over rare earth exports, while US officials warned of threats to global supply chains. Meanwhile, Powell's dovish comments and signs of a cooling labor market have investors almost fully pricing in another 25 basis point cut this month and probably one more in December. Gold's rally isn't just about fear, it's about conviction. Central banks are buying, ETFs inflows are strong, and traders simply don't see a reason to fade the metal. That's already up more than 60% this year. Yes, you heard right, 60%. Even though short-term charts show some overbought conditions, the bulls seem to be unfazed. Technically, key support areas are around $4,250, with deeper levels near $4,140 and then $4,050. The resistance is, well, parked near the record highs between $4,379 and then $4,400. As long as rate cut expectations keep the dollar subdued, gold looks determined to test the limits of the word expensive. The big question now is whether 4,400 becomes the next psychological barrier or just another milestone on the way to something even bigger. And then there's the S&P 500, America's favorite mood ring. The index closed lower on Thursday, down around 0.6%, as concerns about bad loans and regional banks once again spooked investors. The financial sector led declines, with regional lenders like Zion and Western Alliance tumbling after disclosing loan losses tied to potential fraud. That revelation dragged the KBW Regional Bank Index down about 6%, reviving memories of some previous credit crashes. So, beyond the banking headlines, markets are still wrestling with the same mix of trade tension and government shutdown that's stretching into its third week. Investors are wary, liquidity is patchy, and sentiment feels fragile. The S&P 500 is now hovering around 6,600, just a fraction off from yesterday. But still, more than 12% higher than a year ago. In other words, it's been a good year, just not a comfortable one. With the Fed expected to cut rates again later this month, traders are, now trying to balance optimism over easier policy with concerns about financial stability. Technically, for now, the landscape shows 6,580 as the near-term support, while 6,640 remains the ceiling. Whether we see a retest of the all-time high at 6,764 will all depend largely on how quickly markets digest these regional bank stories. After all, even the strongest bull market can catch a cold if credit jitters spread too far. So here's a question. If credit stress lingers but policy easing expectation deepens, does the index trade range-bound under the highs or attempt another push when bank headlines start cooling down? So heading into the weekend, the focus shifts to whether gold can finally push past 4,400 and if the pound can hold its footing above $1.34. And then lastly, whether US equities can, regain composure before Monday morning's market open. The calm currently feels a little temporary. The kind that, markets usually break just when everyone starts to relax. And with that, we wrap up your daily market brief, brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Head over to ATFX Africa by clicking the link in the description below and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.